Good morning, everyone. My name is Shulin. I am the Chief Executive Officer of OUE Commercial REIT. Thank you for tuning in this morning to let us have this opportunity to share with you and help you better understand the REIT. Let me now begin with an overview of OUE Commercial REIT. We are one of the largest diversified REITs listed on the Singapore Exchange with a total asset under management of 6.8 billion Sing dollars. We have 7 high-quality prime assets, of which 6 are located in Singapore and 1 in Shanghai. And together, we have more than 2 million square feet of net lettable area and 1,640 upscale hotel rooms. Our investment mandate is in commercial sector, commercial assets, as well as hospitality-related assets. The sponsor of OUE Commercial REIT is OUE Group, and they have a 47.8% stake in the REIT. As you can see, we started off in 2014 with just 2 assets worth 1.6 billion. And over the years, we have acquired 2 more properties to grow to 4.5 billion in 2018. But the transformative change that the REIT went through was really last year when we completed the merger with OUE Hospitality Trust, and as a result of this, we are now the largest diversified REIT, as I mentioned, with a total portfolio under management of 6.8 billion Sing dollars. And you can see here the properties that we have in the portfolio. Basically, the first 4 that you see in the picture, in the slide, is in the commercial sector: OUE Bayfront, One Raffles Place, OUE Downtown, and Lippo Plaza. So these are our key prime commercial office assets. Next is Mandarin Gallery, which is a upscale retail mall in the Orchard Road, and followed by Mandarin Orchard Singapore and Crown Plaza Changi Airport, which are our hotel properties. So in short, you can see that our properties are strategically located assets in prime business districts of Singapore and Shanghai, and for the hotels, they are also located in very prime areas. The portfolio composition, as you see here, is 94.1% of our assets under management are in Singapore. And on the second pie chart, you will see that we're very diversified in the sense that no single asset contributes more than 24.7% of our total revenue. In terms of the segmental information, you can see that the office sector accounts for close to 61% of our gross revenue for first half 2020. And this is important because given the current situation that we're facing in the midst of COVID-19 pandemic, the office sector provides a very stable cash flow for us, and we are seeing that our tenants are still doing well in this sector. The next sector is the hospitality sector, which accounts for another 24%, and this is actually supported by the minimum rent under the master lease arrangements that we have. So basically, our 2 hotels, we have a master lease arrangement whereby the master lessee will pay us a minimum rent of 67.5 million, regardless of the performance of the property. And if the property does well, if the hotel does well, then they will pay us a variable rent. So given this current situation, obviously the hotels are badly affected by the COVID-19 pandemic, and so we are enjoying the downside protection that these master leases are providing. And the last sector that we have is retail, as you can see, accounting for about 15% of the gross revenue. In terms of our tenant base, you can see that we have a very diversified tenant base, and this is important as well because we don't have any over-reliance on any one trade sector, and this further ensures the resilience of the portfolio. In terms of the lease expiry profile, we have been very active this year and really trying to renew our tenants and trying to sustain our operations. As a result, we have less than 6% of our revenue due for renewal for the balance of the year. And in terms of the WALE, the average lease expiry, it is 3.5 years. Next, let's go into the financial performance as well as the capital management of the REIT. Based on the first half results, you can see that across the revenue, net property income, and amount available for distribution, we saw strong year-on-year increases. And this is the result of the merger that we completed with OUE Hospitality Trust last September. On the amount for distribution, you can see that it is a smaller increase of 12.1% year on year, and that's because we have decided to retain a 13.8 million in the first half DPU, and this is to provide the REIT with added financial flexibility, which we believe we would need in order to help us and help our tenants tide through this difficult period. In terms of portfolio performance, you can see that the commercial segment occupancy rate is 91.6%. It has come down from about 94.5% a year ago, and that's really because of the very weak economic outlook that we have and the challenges that we are seeing now in the marketplace because of tenants are really looking at cost containment measures. But nonetheless, despite the decline in the occupancy rate, you can see that we still enjoy a good 6.8% to 14.8% positive rental reversions. So this means that when we renew our tenants, for those tenants who are renewing with us, we are actually able to increase the rents that we are charging them in the renewal cycle. In terms of capital management, the aggregate leverage for the REIT as at 30th June is 40.1%, and we have an average cost of debt of 3.1%. So in terms of how we manage our interest rate flexibility, we have our fixed rate debt. So basically this means that regardless of how interest rate moves, 80.7% of our interest rate exposure are on fixed rate basis. And in terms of how we try to shore out our liquidity and how we manage our refinancing, we have diversified sources of funding. As you can see, we issued a good $100 million of bonds in June to really help us to manage our balance sheet. So you can see on the chart on the right, this is our debt maturity profile. So for 2020, we have slightly under 600 million of debts that are due for the 2020. And as I mentioned, we are actively issuing bonds and talking to banks to refinance this, and we are in advanced negotiation with our bankers, and these debts should be renewed or refinanced ahead of maturity by end of the year, with an average cost of debt being stable at the current 3.1%. So now I will share with you how we navigate through the COVID-19 situation. Going by the various segments that we're exposed to, office, as I mentioned earlier, is the very resilient part of our portfolio. But nonetheless, because of the weak economic outlook, as well as the suspension of leasing activities, so during the circuit breaker period that we went through in Singapore for the good part of second quarter, we weren't able to market our properties, we weren't able to show our properties around to prospective tenants, which is why there was a decline in the committed occupancy. But nonetheless, as I mentioned, we continue to see upwards reversions in our rental rates, and as a result, we saw stable performance in our commercial office properties. In terms of the retail property, it has been badly affected because number one, we don't have tourists in Singapore, and because of the circuit breaker as well, our retailers have to close their shops. But thankfully, because we are now in phase 2, all our tenants have resumed operations and they have opened their shops. And we have also seen encouraging signs of shopper traffic increasing. So in Mandarin Gallery, the shopper traffic has actually rebounded to close to 70% of pre-COVID levels. However, in One Raffles Place shopping mall, because this is located in CBD, as we know, most of the working population are still working from home. Hence, the shopper traffic in One Raffles Place is just about 30% of pre-COVID levels. But we are monitoring on a weekly basis, and we are seeing encouraging signs of this increasing. The next sector will be the hotel, which obviously is very badly affected because, as I mentioned, we don't have tourists in Singapore anymore. But nonetheless, the hotel operators, they have been very active and they have sought alternative sources of demand. And these come in the form of guests serving the stay-home notices. This come in the form of Malaysian workers who are affected by the border controls between Singapore and Malaysia. So they are all housed in the hotels that we have. But nonetheless, as I mentioned, we have downside protection for the minimum rent component under the master lease arrangements that we have. So how do we then help our tenants? Because at the end of the day, our cash flows come from our tenants. So we need to make sure that our tenants do well and they are able to be stronger at the end of the COVID-19 pandemic. So what we have done is we have passed on in full all the property tax rebate as well as the cash rebates that the government has generously provided us, and that is to the tune of about 19.9 million. But on our hand, on the landlord's end, we have also provided various assistance schemes to our tenants, such as rental rebates, flexible rental payment scheme, as well as various marketing assistance. And this is to the tune of 13.8 million. So in total, our tenants have benefited close to about 34 million of rebates to help them tide through this situation. So now I'll provide some color in terms of the operating matrix of our commercial segment. The occupancy rate, as I mentioned earlier, has declined by about 2.7 percentage points to sit at about 91.6% now. And this is really, as I mentioned, because of the weak economic outlook, dampened the leasing momentum, and then compounded by the suspension of leasing activities during the circuit breaker period. So I think right now in phase 2, we definitely see increased activity. We are starting to show prospective tenants around and counting. So we believe that we should see some uptick in the occupancy rate going forward. However, in Lippo Plaza, you can see that the dip in the occupancy rate was slightly larger at about 4.7%, and this is really because the demand continued to be weak due to persistent business uncertainties, as a result of the trade tensions, the relations between US and China. And I think we continue to see some pressure in this market, which is why in Lippo Plaza in Shanghai, our strategy now is really to do whatever it takes to sustain our occupancy and to make sure that we will continue to drive occupancy and to drive some organic growth for this property coming from increasing our occupancy rate. So looking at the rates, as I mentioned, the Singapore properties enjoy strong rental reversions to the tune of 6.8% to 14.8%. And you can see very clearly in the table there that the rents committed during the quarter, during second quarter, were higher than the average rents of the expiring leases. In Lippo Plaza, one thing interesting to note is that the range of the committed rents, as you can see there, ranges from 550 per square meter per month to 1090 per square meter per month. And the reason is because, as I mentioned, we are now adopting a strategy to really be very competitive in our leasing structures, in our rent structures, so that we can retain our tenants, so that we can drive the occupancy rate of the property. But nonetheless, the 1090 also reflects that, for tenants who still have clear business outlook, who still have, who are still looking to expand their business, they are able to pay higher rents, and that's what we are trying to do. For tenants who can pay, we'll try to maximize the rental rates, and for tenants who are struggling a bit, we'll be more competitive in our rents, and that's really to make sure that the Lippo Plaza performance will be stable. So looking at the average passing rents for our portfolio, as you can see, because the Singapore portfolio has been enjoying consecutive quarters of positive rental reversion since 2018, this has resulted in the upward trend of the passing office rents for our properties. In Shanghai, as you can see, it's very interesting as well. Despite the dip in the occupancy to about 80%, we're still enjoying stable rents. And that's really because of the strategy that I just mentioned to you, that where we can, we will try to maximize rental rates. And where we can't, we will try to be competitive to sustain the occupancy. Mandarin Gallery, our retail property, as you can see as well, the average rents is stable. And that's also our strategy, to keep the properties as stable as we can to sustain occupancy rate. Looking at the top 10 tenants of the commercial segment, you can see here that we don't have tenant concentration issue because the top 10 tenants account for about 27% of the revenue. And you can see the names here, they are all large corporations and multinational corporations. Finally, let's go into the hotel segment. So basically, you can see that, no surprises here, that the hotel segment saw a drastic decline in performance, with the Mandarin Orchard Singapore declining by about 63% in terms of its RevPAR performance. So RevPAR is basically the revenue per average room. So MOS declined by about 63%. But interestingly, you will notice that Crowne Plaza Changi Airport, the decline is lesser at about 40%. And that's because on top of the stay-home notices guests that they are serving, Crowne Plaza has the added advantage of being in the Changi Airport vicinity. So they are also serving the air crew that comes from the cargo and the commercial flights that's coming into Singapore. Hence, because of this additional leg of demand that they are enjoying, the decline in the RevPAR is not as great as Mandarin Orchard Singapore. So our view is that we think the hospitality segment will continue to take a longer time to recover because it is highly dependent on the resumption of international air travel. Hence, what we are doing is we're looking at the portfolio to see what we can do to future-proof our hotels and to really make sure that when the recovery comes, we're in a better position to take advantage of the recovery. So we have hence decided to do a rebranding exercise of Mandarin Orchard Singapore to Hilton Singapore Orchard. And what we'll be doing is to add on new income generating spaces to drive growth in sustainable returns and value for the property. We'll be looking to convert some car park space in the hotel to more higher value added generating space, and as I mentioned, so that when the recovery comes eventually, we will be able to drive returns for this property. So besides just refurbishment and converting some and adding some new income generating spaces, we're also changing the software of the property, and hence we are rebranding it to Hilton Singapore Orchard. And the reason is because we believe in the Hilton's strong brand recognition and its global sales and distribution network, which we believe will bring benefit to the hotel and to the REIT and to unit holders. The rebranded hotel, we believe and we hope that it should be launching in 2022. And once that happens, it will be Hilton's flagship hotel in Singapore, and it will be the largest Hilton hotel in Asia Pacific. One important point to note on this rebranding exercise is that during the period of the renovation, during the period of the ramp-up period for the new hotel, there is income assurance for unit holders in the form of the minimum rent that I mentioned earlier under the master lease agreement. So this master lease agreement still stands, and we will still enjoy the 67.5 million that is accorded by the master lessee. So I will now conclude my presentation by just sharing with you what is our immediate strategies and focus for the REIT. It is really just two very important prongs: asset management and capital management. We want to continue to drive organic growth in the portfolio and to strengthen our balance sheet. So on this front, in terms of operations, we will continue to be very proactive in lease management to retain tenants, to retain and to sustain occupancy. And obviously, the health and hygiene factors are very important now. So we've also stepped up and intensified the frequency of cleaning and implemented various safe management measures so that eventually when the working population comes back to our properties, they will have a clean and safe environment to come back to. And on the capital management side, we will make sure that the balance sheet remains healthy. Currently, we have a healthy balance sheet and sufficient liquidity to meet operational and financial commitments. As you know, MAS has increased the gearing limit for REITs to 50%. And for our REIT, whereby we are currently at about 40% gearing, this gives us a buffer of about 20% in asset values before we hit the 50% gearing limit. And this translates to a good 1.2 billion Sing dollars. So I think we are very safe and we're very comfortable with the gap that we have. And in terms of the credit facilities, as I mentioned, we are working to augment our working capital for refinancing needs as well as to meet our daily operational requirements. And despite all these things that we're doing, we expect the average cost of debt to remain stable. So in summary, if you invest into C-REIT, what do you have? C-REIT offers unit holders a very high quality, strategically located landmark assets. And why is this important? It's because quality assets are always well positioned to maintain their values through economic cycles. So as I shared, we did see some dips in the occupancy rate, but because of the high quality, because of the strategic locations that they're in, they tend to rebound faster as well when the economy recovers. And we've seen in the last 7 years since we were listed that the assets that we have yielded resilient performance since our listing. Secondly, in terms of the capital base, post the merger, we have an enlarged capital base, and this provides us with improved access to various sources of funding, more competitive sources of funding, and this is important because it will then allow us to undertake larger asset enhancement initiatives, such as the rebranding exercise of Mandarin Orchard Singapore. Third, because of the merger as well, we have an enhanced portfolio diversification, and this is important as well because we have reduced the concentration risk of each asset. We have reduced the concentration risk of each asset class as well. And the stability of the REIT can be seen in two folds, which is the office sector. As I mentioned, we are still enjoying very stable performance there, and the minimum rent component of the hotel. So in total, these two sector accounts for 85% of the revenue base of OUE Commercial REIT. And lastly, we are now enjoying a broadened investment mandate. So when things settle and when we're ready to look at acquisition opportunities again, we will have the ability to look at mixed-use development, to look at integrated development. And why is this important? Because we definitely see the future of land use, we definitely see urban planning going into this direction, whereby office workers, will commingle with retail spaces, as well as hospitality with hotels and things like that. So we have the ability to evaluate all these opportunities. And in terms of the ability to also adopt another strategy to support and augment our investment mandate, is the ability to look at asset recycling. So post the merger, we now have 7 properties compared to 4 before the merger. So with 7 properties, we can really look at portfolio reconstitution, looking at asset recycling to support our asset growth strategy. So with this, I've come to the end of the presentation. Thank you for your attention and have a good day.